Staying with autos, Jim Cramer joined us yesterday. He had some harsh words for the auto sector.
If it has auto, as much as I think Phil's right in terms of the 17 million, auto is a bad place to be because you have Mexico Auto, you got China Auto. PPG makes the highest end finishing. They're the ones you really want. They're the wealthy cars. The healthy cars are PPGs. And I don't want to see Lux, the luxury side of things, get hurt. And PPG is synonymous with luxury autos.
Let's bring in Michael Ward, senior analyst with Williams Trading. It's good to talk to you today. Michael, what did you think about what Jim Cramer had to say about autos and the industry as a whole?
Well, I think he's wrong, but that's another issue.
Tell me why.
Well, I mean, first of all, I think he's focusing on the car sector of the market and luxury car sector of the market. And that side of the market has been slowing pretty dramatically for the last 4 to 5 years. I mean, look at trucks. Trucks are through the roof. Trucks are more profitable. If you look at truck sales since 2009, they've doubled. They're up 7.3% in the last 12 months. Sticker prices on trucks, the average expenditure by a consumer is up $10,000 per unit. I mean, drive around any neighborhood, the family vehicle of choice is a Chevy Suburban. They're $80,000. That's a luxury car.
Are those cars going to get more expensive, though, because the cost of materials is skyrocketing?
Material cost is definitely a factor. I think you have to look at that. But one of the things you've seen historically with raw material costs, particularly steel, because that's what you're focusing on, steel prices, the vehicle manufacturers have several contracts that kind of fold as a natural hedge. And so you're not going to see a 30% increase in steel costs in one given year. It'll be staged in over time. So steel costs, if you look at the raw material component of a vehicle, a steel cost is about $1,500 on an average vehicle in the United States. And so if you're up a couple $100, yes, you price some with the consumer, you eat some, and you also have more favorable contracts with your suppliers.
If trucks are so hot, why isn't Ford?
Well, that's the question of the day, right? I think the real question is, why are the auto stocks not performing as well as they should be, given the valuation and given the outlook in the industry and given what the companies have restructured over the since the downturn? One of the things that I keep pointing to is the stocks have become less relevant. If you look at General Motors and Ford in particular in the 80s and 90s, they were about 2% weighting in the S&P 500, or a top 5 type stock in today's market. When you look at their weighting today, they're 35 basis points. They've largely become irrelevant. They've been priced out of the market. And then you get into the question of why. Why are people not paying attention to them? And I think part of that is tech. I think there's this belief that the tech industry is going to take over the auto industry. And certainly Detroit is not going to out-tech Silicon Valley. But if the tech industry is going to look to grow revenue through the auto industry, they desperately need the auto manufacturers for production, for regulatory, for distribution. That would take decades for any auto industry, or I'm sorry, any tech company to replicate. And as evidenced by the SoftBank and Honda investments in General Motors Cruise, they need the auto industry. The auto industry is very relevant to the tech industry.
So even though the stocks are trading absolutely dismally, you're basically saying that investors simply are using that money instead to invest in other higher growth or what they perceive to be higher growth areas?
Absolutely. I think when you look back in the 80s and 90s, and I've been following the industry since 1982, any portfolio manager you talk to had an opinion on the autos. You know, it is an easy sector to understand, but they always had an opinion on the autos because they were relevant to the market. When you look at it today, if you miss a move in General Motors and it's 0.18, 18 bips weighting in the S&P 500, you're not getting hurt that bad. I mean, you miss a move in Amazon or Google, you're going to get hurt badly.